Gotta jam out. This is what you call middle-aged old man dancing. What's up, guys? Welcome to another episode of Rockstar News, the podcast. This is episode 3. Today, we're going to be talking about paying down your mortgage and how you can pay it off fast, save a ton of money. Special guest is going to be Bryan Clark, broker associate for Century 21 Alton Clark. And once again, joining me is the non-bearded one there.
It's growing.
It's growing.
No shave November.
No shave November. I didn't do that. I just keep doing my scruffy Keanu Reeves.
Because it doesn't grow. It's actually stuck there.
Yeah, it's just stuck on my face, whatever. But anyways, Bryan Clark, welcome to the show. We appreciate you guys, or appreciate you coming on.
I do have multiple personalities, so I can understand why you said you guys. It's great to be here.
Yeah. So, all right. So before we begin, I kind of want to throw some stats at you, just to, so the people at home can actually see like what we're actually talking about. All right. So typically when you buy a house, you get a 30-year fixed mortgage, correct?
Mm-hmm.
Yeah. It takes about, most people have this idea in their head that it takes about 30 years in order to pay down a mortgage, and they're going to spend a buttload of money on interest when that comes to that. So in the second quarter of 2019, the mortgage balance for all Americans was about $9.4 trillion.
It's unreal.
Yeah, unreal. About $162 billion more than the previous quarter, according to data released Tuesday by the Federal Reserve Bank of New York. This surpassed the previous peak of $9.3 trillion in mortgage debt recorded back in the third quarter of 2008. Homeowners saw their equity, but here's the thing, here's the upside of this. Homeowners saw their home equity increase by 4.8% annually at the end of the second quarter. This is a collective gain of about $428 billion in equity. Break it down by borrower, the average homeowner with a mortgage gained about $4,900, about $5,000 in home equity in just 1 year. All right, so, I mean, what are the things that, when you buy a house, you get a mortgage, what are the concerns and the issues that most home buyers don't take in consideration?
Well, in all honesty, a lot of people don't even understand fully how the mortgages work.
Mm-hmm.
Yeah, I think it's just kind of not a lot of education is focused on sort of educating people how to get out of debt, because, the bank doesn't want to tell you all that good stuff because they want to make the money.
Yeah, because they got to capitalize off interest.
Correct. And since the majority of the people usually statistics show they move every 5 to 7 years-ish, sometimes 10. Folks don't put a lot of weight into paying down the mortgage, if any. And but debt's a real thing, and Americans are constantly in debt, and you can't really do what you want to do while you're in debt. People work jobs they don't want to work because they have to pay a mortgage, all that stuff. So
it's house broke.
Yeah, and that's
borrowing at the top of your budget when you don't necessarily have to if you can.
Correct. And there's a lot of decent information out there, but a lot of this stuff is just people can't do. Everyone's like, oh, split your payment in half and send it in every 2 weeks. Yeah, that'll shave like 6-7 years off, but it really won't make a huge impact. They're like, oh, do a 15-year mortgage. Well, that payment is going to be significantly higher, and most people can't do that. So what how do they do that? And that's kind of a little bit what we're here to talk about today, and just kind of finance in general.
Yeah, I mean, here's the thing. Like, I've talked to other mortgage people, mortgage lenders out there. And by the way, he's not a mortgage lender, but you worked in financial planning for retirement stuff. So you have a good grasp of what financial independence and people having strong financial literacy and how that can benefit them and how it can hurt them if they don't have that.
Yeah. So what's your experience on that? Can you elaborate a little?
Yeah, in the past, I remember it was like, what's this realtor guy doing talking about all this? Well, back in the day, early 2000s.
Don't discredit yourself, sir.
I know. I mean, I sold a debt elimination software program in a pretty big way. And it's making a comeback now again because the way it was set up back then, the market crash eliminated a lot of opportunities to use it. But it's gone through a rebranding and a refixing of how it works in today's market, and we'll talk a little bit about that. But I was also a retirement planner. There was a common thing that all these people who had huge portfolios had, and it was very simply real estate in a big way. Not a lot of them were in stocks and bonds and all this other stuff. They had dabbled in it, but these people that were reaching later in years, like late 50s, early 60s, and they all had something to do. They had big insurance, dividend whole life paying insurance, and they had their mortgages paid off and multiple houses. They had rentals and all that good stuff. So I was like, man, there's got to be a pattern here. And all of them expressed to me, we figured out a way to sort of have one house pay for another house and trickle, and that was great. But for those folks who just usually end up having one, there was no real game plan. And so I've been dealing with this kind of stuff since early 2000, and it's amazing when you start reading about things like Nelson Nash's banking life book that he wrote, where he has you treat insurance products like bankers do in the bank, and loaning against yourself. It's crazy. So yeah, a lot of years reading on this topic and living it myself, and it's fun.
You're a financial planner, right?
Yeah.
How long did you do that for?
I did that for about 6 years, 6 or 7 years. And it was a lot of fun, but then the market crash knocked on everyone's door.
Yeah, I think it's a simple story for a lot of people out there. Like I had a
yeah.
business doing renovations, and 2008 it was like,
yeah. It was like, oh, this is awesome. Oh, no.
no,
awesome
we're done.
anymore.
I mean, I literally
Back to a
had
9 to
people-
5.
They were like, no, mattress money. That's it. I'm putting it all under the mattress. I'm like, no, don't do that.
Yeah.
So yeah, it was. I mean, but still, I wouldn't trade that experience for anything because I learned so much. Especially, I got to meet Nelson Nash, and he talks about that infinite banking concept, and it changed the way I view a lot of things and the way I do things. And ever since then, it's been night and day. I do things you guys know. I mean, a lot of my stuff is paid for and done, and
Yeah, because you stay below your means, right?
yeah. That's man. It's
Well, dude, that's what. Okay,
Is
so
it
that's one of the
easier
things.
to live within your means, or is it harder?
Well, here's the thing. Like, I think that's the fundamental key when it comes to like when you like you're trying to save money or you're trying to build wealth. The idea is that buying toys and trying to keep up with the Joneses is going to be your worst enemy. Like you're literally gonna nickel dime yourself to death to the point where like you're making $100,000 a year, but you're spending 110. You know, and then that interest is
that
growing
debt.
on that. Yeah, and it's just like, why live that life where you're trying to sit there and try to make ends meet so you can try to impress people you don't like?
Yeah, so it kind of boils down to materialistic.
Yeah,
society.
materialism,
Like we
yeah.
have too much shiny object syndrome going on.
I mean, if I could tell you watching anything, the Joneses are terrible people.
They are.
I mean, because ignore what they do. Here's the thing.
Disclaimer: we're not talking about any particular. Joneses.
Yeah, if your real name's Jones, sorry. No, but in this Instagram instant world of, I mean, you've seen these broke people pretend to be rich on Instagram.
Oh yeah, going up
Like,
to a random stranger's car and pretending it's theirs.
oh, they do it all the time. And so, people want to kind of follow these fake lives and they don't know the real deal. And so it's not bad to have aspirations to be successful, and everyone has different levels. I was a young man and dumb. I made great money. I bought a lot of things. I thought I was, living the high life. And then next thing you know, there's nothing once it all disappears. And so it wasn't smart. And I see a lot of people kind of going down the same road. But just, number one, don't believe all the hype, because most of it isn't real to begin with. And, your friend gets a new Tahoe. Well, you don't know. They got an interest-only loan on their house, and their Tahoe's financed for 72 months. Like, they may look cool, but they're going to pay triple what that dang truck is worth. Is that really?
You know how
Is that
funny of a
smart?
story that is? Like every time I go talk to like a seller who's thinking about selling their house, they're either like at first they start off as like a for sale by owner. They're doing it on their own, whatever. And they're always like, well, I think your assessment of my property is a little low. My neighbor down the street sold hers for like $400,000. And you go look up, the
That
records. You look at the property and stuff like this, and they actually sold it for like $320.
Yeah, your favorite word,
And-
like, no, it didn't.
Yeah, like no, it didn't. It's just like I was like, your neighbors lie to you. Like she
Yeah.
wants to sit there and be like, yeah, I sold mine for $400,000.
It's the whole, my fish was this big when it was that big. It's
Exactly.
just-
Like people lie.
yeah, they don't want to know the truth, because sometimes the truth stinks. When you move into a house and all that stuff, and it's daunting. You only pay interest pretty. Do you know the year at which you get halfway done with your mortgage balance? Do you guys have an idea?
No.
20
Wow.
years
out of a 30-year.
before you're halfway, and they're like, "Whoa, why is that?" Well, it's very heavy.
Hey, you would think it would be 15 years. Yeah.
No, it ain't.
Yeah, it's not even down the middle.
No, so
It's all interest first, right?
just having that education and knowing that, how do we disrupt all this? How do we do all that? And that's kind of like that journey that I went on, and because there's not one way of doing things. There's multiple different ways, and they're like, well, why doesn't everyone know? Well, people just choose not to, and they want to go down their ordinary path because that's what so-and-so told them and so-and-so told them. But when you start sort of asking questions and looking around, you're like, wow, people are doing things a little differently than how I was trained. And since we don't have any financial education for whatever reason in schools, we're left to our own devices. So
Yeah. And
So I mean, like, okay, so if you were just you had a 30-year fixed mortgage and you're just trying to figure out, one of the things that you look online, you're kind of perusing, you have no idea. One of the things that they talk about is pay extra payments. And you can equivalent, like, you can do, instead of 12 months, you do 13 months
13 and a half.
13 and a half.
Yeah, that's essentially the cutting it in half. It gives you one extra payment a year.
Yeah.
And a lot of people go that route. I suggest it to my clients all the time.
Yeah.
It helps them a lot, especially if they plan on being in the house for more than 10 years.
And that's better than nothing, to be honest with you.
Well, I think the key here is that we talk about you could pay extra money. You got to have that extra money.
But, yeah, but also who is determined enough to continue that habit? And that's where the difference with the software that I talk about is different than just sending extra money, because, not like you said, not everyone has extra money. Sending the extra money doesn't factor in you changing cars, doesn't factor in that $2,000 vacation you took. Doesn't factor in any of your credit cards, because here's the real deal, folks, is people are like, oh, I have a savings account, I got $3,000 in there, yet they have $10,000 in credit card debt that they're paying 18% interest on. To me, that's crazy, because you're never going to catch up if you're not canceling out the interest, and that's what that software program helps do.
So what is this software program?
It's a company called United Financial Freedom. They used to be You First Financial back in the day, and they were Ernst & Young winner. We were in a lot of success magazines, wealth magazines, mortgage magazines. These guys out in Utah had a mortgage company. They saw their clients continually coming back and refinancing on a regular basis, and they're like, hey, there's got to be a different way, because they were just getting themselves more and more debt.
So is this like a debt consolidation?
No, it's not a debt consolidation. What it is it's a software that you purchase, and what it does is it tells you how and when to move money to cancel interest out on your various type of loans, whether it be your house, your cars, your credit cards, all kinds of different stuff. Because that's the difference between just sending extra money versus having a game plan. It calculates interest float. So what I mean by that is, if you've ever, let's say, charged up your groceries at $500 on a credit card, right? So you have $500 on your credit card, and your payment's due the 15th of next month. And if you pay it off before then, what interest do you get charged? $0, right? That's called interest float. So once you get past that payment due date, then you get charged interest. And so that's how, and it'll stack on whatever percentage you're at. But so you basically borrowed that money for 15, 30 days at no interest, and it's called an interest float. So the software also calculates between the different venues you have. Back in the day, it was only home equity line of credits. So obviously you can see why that got shut down during the crash.
Quite quickly.
Yeah.
But now they do it with savings accounts and regular checking and all that good stuff. But it views the timing between all the different facets you have and tells you move $250.83 to your vehicle loan, or $583 to your car loan. And it actually calculates the best time to cancel the most amount of interest. So that's the big separator between people just sending extra money, because what's really cool is that it has real time. It tells you the date in the year that you will be debt free. And that's nuts, because when you see it, let's say you were wanting to go on a vacation. It's like, oh, it's time to go to Europe finally. And it's, $5,000, and, it's an experience of a lifetime. I put that in there, and let's say my initial payoff time, because typically it's 1/3 to 1/2 the time of a regular mortgage is what they boast. If I put that in there, it'll recalculate the time. So let's say my original time was 11 years. I put that trip in there. It may change it to 12.2 years or 11.7 years.
Wow, just by calculations.
Just by calculations.
It knows. So I guess you have to link all of your accounts, right?
No, you don't have to do that. But when you set it up with the home office, they basically show you how you have your expenditures, like groceries and everything, can be under a category. And it works like Mint. Many of you are familiar with Mint, where you set your budget, and as you use it, it fills up. It's the same thing in a sense, but the difference between Mint and all these other free products is just kind of give you an idea of what you're doing. Is this gives you the solution to get out of it.
And it can provide you like a breakdown, is what I'm gathering, of a timeline and how much and when.
Tells you the exact day, like when to move money, from where, how to do it, the whole bit. It's nothing like I'd ever seen before.
How come this isn't being broadcasted? I've never heard of this in the 4 years I've been doing real estate.
Here's the thing. It's been around since early 2000s, and it was being, I mean, these guys are out in Utah. We had 80,000 agents, and we were selling this thing like hotcakes. So, and even then, at that point in time, like I said, there were in publications everywhere. But think about it for a second. Do banks really want this to be known? Do credit card companies want this to be known? Like,
no.
Why would they broadcast it? So, you know, it's the same thing with Nelson Nash's infinite banking concept is, you know, it's a fantastic thing, but insurance agents don't really push the product because they don't get paid very well doing it because the certain products that are used are not high-paying products. So insurance agents will push the ones that they make more money on. So, you know, because those are the same questions I always ask. Like, why didn't I know about this? Walt Disney bought Disney with the infinite banking concept. Like, holy cow, really? Yeah, he did a dividend-paying whole life because the banks wouldn't give him money to buy stuff. So it's like, okay, you start looking through the Kennedys and all the people that passed. What have they done? And they've used a lot of this stuff. And this software, they just reopened about 5 months ago to like they were selling direct to the public, and they brought agents back in. They had, you know, like 10 agents, and they're already over 2,000. So
wow, and this company just came back when?
Yeah, just came back the other day, like 4 or 5 months ago.
4 or 5 months, and already 2,000 employees.
Yes, because they were just doing, like I said, after the market crash, they were
doing
it themselves. They had to, but they wanted to service their previous clients. They weren't just shutting down, but until they could figure out how it could be used without the home equity line and all that good stuff. They were just maintaining and all that stuff. And now that they figured all that out and redid it, it's crazy. So the growth this time around versus last time is exponential because people knew it worked. There's tons of people on their website. You can see the testimonials. They paid their debts off. I had a lot of clients pay their debts off. And
is this like a subscription, or is this something like one time, like you just bought like a program?
Well, they have a lot of different ways you can do it. You can do PayPal, and they have interest-free over 6 months. They have a single purchase, and then you can set the software to pay that off fast.
So you can tell the software to pay itself off.
Oh, yeah. It's not, I was laughing my butt off when they said that. I'm like, yeah, no kid, that's smart. But, yeah, so they have different payment methods, but obviously the cheapest way is just to buy it all at once. Or do the interest free for 6 months. So,
okay, so before we get into all that, because let's
Kinda
say I'm a broke guy, you know, like
of course,
I want to pay off a mortgage, I want to be financially independent, but I don't have any money for this program,
right?
So I mean, like, if you were, you know, right now, if you're just trying to figure out, like, what besides that program, what are some of the other ways that you would consider to, you know, besides paying, like going to like a bi-weekly schedule, paying your mortgage every 2 weeks, every time you get a windfall, a bonus, or something like this, some kind of lump sum you can pay towards your principal, and then have your, which is basically called recasting. You can essentially have your you know, your schedule reschedulized or recalculated. So I mean, like, what is like a cheap, easy way for most people to kind of have see the horizon of paying off the mortgage before they become too old?
Well, and that's a good question. They have a broke guy payment plan as well for that software, but it never goes away. It's like leasing.
Yeah.
Whereas when you buy it, you have it forever and you're not paying anymore. The monthly option just goes on continuously until you want to, like, you can pay the difference. So for someone who's, you know, having financially concerned about that, then they can do that. But outside of that, here's the thing I say to that, Mike, is that most people have debts in other arenas that are far higher in interest than their home. And they will continue to bury themselves with those other items. And so the movement or the money that they move over the mortgage will never really account to much as long as those things exist. So if, for instance, for those of you watching, think about if you didn't have a car payment, or if you didn't have credit card debt, or you didn't have all these other things that you're sort of obligated to, you know, then what could you do with your mortgage? You know, and then it starts to snowball. When you add it all up, it's like, whoa, man, that's actually a lot of money. Because people, it's chopped up so little to where a tolerable taste, like when you go into a dealership and they're like $239 a month, and they don't tell you it's 72 months. You know, your $15,000 car is now $30,000. So it's working. It's starting first to get some financial awareness. What I would advise the broke person is buy a book, read something about financial education and a sense of how to view and understand how money works. Because any money that you spend in educating yourself, you will start to see the patterns, and you'll start to understand the importance of how can I go about doing this. Speaking to, debt consolidators, debt counselors that are paid by the government, not the ones that, take a big cut of what they do for you, can help eliminate some of those other obstacles. Because I have people tell me all the time, I don't have the money, yet I see them go out to lunch every day. And it's like,
that's where you don't have the money.
You do have the money.
Yeah.
You just don't. You're spending it in the wrong way.
Well, I think there's a deeper core issue to that. It's like meal prepping, going grocery shopping.
Yeah.
That's where you save money.
Yeah, for real.
Yeah, we have a question from one of our viewers.
Sure.
When do you know when is the best time to refinance?
And when I was a broker, I mean, that's a great question. It's really tough. It depends on what you're trying to do. Like, I was in a situation, my wife and I, where we were thinking about pulling money out of the house. And I was like, a lot of people would probably refinance to do some of the projects we wanted to do. Some of my investor friends are wanting to go buy more property and they want to pull cash out. Refinancing, to me, isn't always the best way to do things. If you have the ability to do a home equity line instead, because those are functions.
Those are my favorite.
Yeah, those function more like credit cards. So you can pay those off and borrow against them pretty regularly. Usually they only have the shelf life about 15 years, so they're not, and people will tell you, well, refinancing, I can do it at 3.5%, and if I do a HELOC, it's 6%. Well, if you're using a home equity line like we teach our clients and some other people, you cancel out interest by throwing in whole paychecks and then borrowing against it to buy groceries and having it fluctuate.
I see a lot of apps
essentially
these days.
essentially it's a credit card, and if you pay it off at the end of the month, you don't have to pay any of the interest.
Correct.
Now, this is the reason why I like it. Like, I know plenty of people out there who have a ton of equity in their property, and they're like, well, how do I tap into that? And a HELOC or a line of credit is one of the best ways to do it, because it's a collateralized, or how do you say that?
Yeah,
collateralized credit card.
Is a word.
Well, the reason why you get a credit card and it has like a 22 to 28% interest rate is because there's no collateral behind it.
You're
it's
just
not backed by anything.
Fake money.
Yeah, fake money. But if you get a line of credit, that's essentially a credit card that's borrowed against your house, and it's treated just like a credit card. You can literally go out there, buy groceries, buy all your stuff, pay it off at the end of the month, pay no interest whatsoever. But you have a 6% interest versus a 22 to 28, whatever.
Yeah, and you utilize that interest float. So let's say you got in some trouble, or unexpected car expenses or whatever came up, and you weren't able to pay it all off. Well, at least it's at 6% and not 18 like on a credit card. So there's a lot of different ways of just moving. I knew a gentleman who would constantly move his credit card balances, because he would move them to 0% interest for 6 months, and then when the 6 months was up, he would move it again. And to me, that's a little bananas
that
and
sounds
tedious.
Pretty bananas. Like, I feel like that would just hurt your credit.
It didn't, but people do these kind of nutty things. It just seemed like a lot of work to me. I would rather have a plan to kind of chop at that balance on a regular basis. And that's when, back in the day, because I was flipping homes and everything back then, and that's when this thing popped up, and I got reached out to, and and I started with Nelson Nash, and then I'm like, man, this is amazing. How do people not know that? It was funny. That's why I laughed when you said that, Chris, because I said it over and over again. This is like so awesome. Why don't people know about it? And, but that's the case with a lot of stuff. There's a lot of things out there that a lot of people don't know about that are fantastic.
We also live in a pretty financial illiterate.
Yeah, it's bad.
And no one wants to face their own money problems.
Money's taboo.
Okay, so you've been in that situation when you're broke, and you're broke, and you have to check your bank account.
But you avoid it because it's in a negative.
Listen,
rent's about to hit, so you're just like,
Mike, if you had to check your bank account, you haven't been broke, because when you was broke as I was, they tell you how broke you is by chasing you. So they're like, sir, bad. We need your car.
No, I'll be honest with you, I've never been that broke before.
It's terrible. It's terrible. They'll chase. You'll know. You don't need to check nothing. They will know.
But I've been in a situation where, I'm sitting there and, you're just too scared to check your bank account for whatever reason.
Yeah, been there.
Sucks.
So, I mean, here's the thing. Just to kind of follow up on that question from the viewer, when it comes to that, when you're trying to figure out, what are your options are. It just depends on what you're trying to do.
Yeah.
You know, I think ultimately, like a lot of people, like the number one reason why people pull equity out of their house in order to
pay debts and credit cards and silly stuff.
It's actually, no, it's wrong. It's actually medical debt.
Really?
Yeah. Ooh. So the number one is medical debt. Like,
a
lot of people go into medical debt. So they use the equity in their house in order to pay that off. So like, it really, really depends on what your goals are and what you're trying to achieve. Like if you're just trying to like refinance to get a better rate, let's say you bought at the height of the market in 2008, and you're still paying like 8% interest. Yeah.
I mean, that
like
might
13. Make sense.
Yeah.
But to be honest with you, if you're only going to be there another 2-3 years, it's silly because you're going to pay more in closing costs and you'll save before that time. But if you plan on staying there for a longer period of time, then sure. But a lot of people don't take that into consideration, and they'll talk to a mortgage broker who's just, I'll refinance because they wanted to ding you for
all
a
fees
refinance, but it's silly.
You still have closing costs when you refinance.
Yeah, you sure do. So if you're going to save over the course of, 2-3 years, $5,000 and it costs you $6,000 to refinance, why in the world would you do that?
It just doesn't make sense. It's just for $1,000.
A lot of times, Mike, is the folks, when they have the situations that they're looking at trying to do, they just don't ask follow-up questions of themselves. Mm-hmm. It's like, what do I want to do? How long am I going to be here? What is this going to be used for? Am I going to be pulling this debt out to get into more debt? Or am I going to just, am I wiping the board clean and then going to fill it back up again? Like, what's the end game?
The biggest thing is, though, it's hard to ask questions when you don't know the questions to ask.
Yeah.
That's where it just comes with, like, financial literacy and just, like, overall education. Is when you're trying to do that kind of critical thinking, and sometimes you just draw a blank because you don't know what questions to ask.
Yeah, and that's a fair comment. And some of that is to, you can help with, when I was telling Mike, you can educate yourself. I mean, they got Bigger Pockets podcasts. They got all these audio books and all these things that are cheap. I always say on my Facebook page, I always get a crack out of when I go to the gas station and I see someone who's hurting financially, you could just tell, and they're dropping $40-$50 on lotto tickets. I was like, golly, man, if you just bought a few books with that same money, you could change your life.
You will probably never touch a lotto ticket again.
No, I never. So yeah, it's a lot of different stuff, but a lot of it has to do with speaking with people who care. Number one, care about you, who can help you, and finding folks that are in that field that you're wanting education on, whether it be financial stuff or debt stuff, and kind of talking to a bunch of different people and coming up with your own conclusion. But if you don't know anything, it's a bad place to make big decisions when you don't know anything. You need to know some. You don't need to be a pro, but you need to know how to find a pro and kind of figure out what they.
So, Brian, what's the name of this program one more time?
The program is the Money Maximize account right now, and it's with United Financial Freedom. If you guys want to check out more information or whatever, just go to bryankillsdebt.com, and that's Bryan with a Y, killsdebt.com, and you can check it out, see how it all works and stuff like that. It'll blow your mind. It was funny. My wife watched it. She's like, oh, my God. She said the same thing Chris said. I'm like, I know. It's a bananas thing. But
for everybody else, I'll link it in the description down below so you can go ahead and just click on it. But, yeah, like I think growing up, because like here's the fundamental problem about everything we just talked about. Growing up poor, you think your mind kind of goes down the same pathways of thinking about money.
Yeah.
When you get money, you spend money.
Yep.
And when I was one of the hardest things that I had to deal with, a lot of other people, like, cause I was a natural born saver. Like my dad, same thing. He kept his budget down to the penny and all stuff like this. Sure. But growing up with everybody else, it was like, once you got the money, it was like, you got to spend it.
Yeah.
It was the feast and famine thing. And I'm just like, what are you guys doing? They're like, well, we got the money, so let's go out there and get lobsters and steaks. And it was like,
let's enjoy ourselves. Splurge.
But they're willing to accept the fact that their life is going to go in these peaks and valleys. There's going to be windfalls and they're going to celebrate. And then there's going to be troughs where they just eat ramen noodle. And I'm like, what if you didn't spend?
Instead of riding the roller coaster, ride the highway.
But that's a mindset that you develop when you grow up poor. It's a very bad mindset, and that's one of the key things that you have to try to do to get out of that. And once you start, like I said, Bigger Pockets is one of the websites that I've gone to. I've read multiple books of theirs. when it comes to like real estate investing, it comes to financial literacy. There's also MrMoneyMustache.com.
That's a good one.
Which he's a blog. He talks about FIRE, financial independence, and retire early. So just being able to get that knowledge out there, because when you grow up poor, you only know what you know.
Yeah.
And so you have to be resourceful, be able to find the areas, because I didn't know about this program either. I was kind of the same way. Like, I've been in real estate for 4.5 years, and I'm sitting here thinking like 30-year mortgage, see you when you're 60.
Yeah, right.
You know,
Yeah,
so,
exactly.
and then when you showed me the video, I was looking at it, I was blown away
I gotta look
by
this up.
the idea that is like, good Lord, you could sit there and save so much money. And because I'm thinking like, you get $100,000 house, hypothetically, you're not going to find that in Orlando.
I don't know.
I know.
That's,
Not
a shack,
around here.
that's a shack in the back.
Not that it has a roof.
And let's say you get 5% interest, you're going to spend $150,000 just off of interest in 30 years.
Just interest.
Just
You guys
interest.
didn't
Yeah,
hear that.
not just paying off
It's
the
like
principal.
double what you pay for the house.
Yeah, so it's exactly, it's double is because you paid 100, so you're paying, you know, about 50% more. So the idea was just like blew me away, and I was like, well, I knew you can pay extra payments off. I knew you can do that. You can probably pay off in like 27 years, maybe 21.
Yeah.
So there was all that issues, but yeah, after seeing this program, it is a game changer for you guys out there who are trying to save money, not just save money, but to build wealth. And I think that's the fundamental key. The difference between
It's hard to build wealth when you got like bad debt.
when you have bad debt, and especially when you
That's
come
when you
from,
got to face it.
Yeah,
You
well,
have to face it. A lot of people just don't face it.
well, that's what I'm saying. Like, you only know what you know. When you grow up poor, you're seeing your parents struggle. You know, the thing that they taught me, my dad and mom, was you're never going to be rich. Get a good job, work your butt off, and then die. You know, that's literally the lesson. And when you start to read and you start to learn from all these people who've been in your shoes before, they've seen the struggles, they know the struggles, and they know, you know, they've gone down this path and they know how to replicate that. You got to learn from those people, and that's what I'm saying. Like, you have to be able to. You have to start reading books. You got to start somewhere. You got to start reading
Start
blogs.
looking to it.
Oh, and that reminded me of
You got to start subscribing to our podcast.
I know, right? Subscribe to the podcast so you get some education up in here. But it reminded me of like you guys saying, "Oh, I haven't heard of anything like this." You know, that concept of that software program where these guys got it from is, you guys know Richard Branson, right?
Yeah.
Virgin. Well, him and the Bank of England came up with a concept very similar to this called the One Account, and they did this years ago. And the UK, because they saw a big surgence of debt accumulating with the housing market, so they did this to kind of and followed a similar concept. It's not as techie or has all these kind of changing moves, but it inspired the young men that founded the United Financial Freedom Company to do this. And also Australia, along with Britain, has a similar thing as well. Because the home debt was being so big, Australians pay off their homes superbly fast by comparison.
Oh, yeah?
And it's because they have a program that's very similar. So
Really?
just because we didn't hear it, it's been around there since like the 90s or earlier.
Well, that's what, like I'm saying, like, this information is out there, but when you grow up in, let's just be real, when you grow up in the hood, like I grew up in the hood, like you don't hear this information because everybody's kind of in this
Their own bubble.
this bubble of poorness, this bubble of poverty that like sucks you in. Like, it becomes difficult. Like I said, I forgot who said it best, but like the hood becomes a mental mentality that you're kind of just like stuck into, you know, and like, and it is like, even if you like get out of the hood and you start making good money, you still think that way, you know. So I've come across a lot of wealthy people who got into investment and you know, helped them buy houses and all that stuff. And they still think the same way.
Yeah.
You know, they're like, they're stingy to the point where like, they're like rubbing pennies trying to get every cent out of, you know, everything out
Every
of that.
cent out of it.
But you know, the saying is like, cheap is expensive and expensive is cheap.
It's so
And-
true.
But like,
So
when you're
true.
poor, it's just like, spend as little as you can, and then things break and they fall apart. And all that.
There's at no point can you save up enough money to outpace
inflation.
inflation,
Yeah.
number one, canceling interest on stuff that has been built up. Now, everyone, you know, for a long time when I lost everything, I operated mainly on cash. And I know what that lifestyle is like. It felt great and all because I'm like, I'm not in debt. But at the same token, I wasn't building anything either.
Yeah.
You know, because I didn't have enough to kind of do these big things. So there's smart ways to borrow money versus not so smart ways, and ways to eliminate debt quickly so that, you know, if you think you're doing a great job because you have minimal or no debt, but you don't have a house, or you're still paying on a 30-year mortgage and you're 7 years in and it's still maxed out. There's something to be said about, using leverage in a proper way to improve your situation.
And we're going to have that on a later episode where
Sure.
we're going to talk about how to flip houses, how to use like little to no money to do so. Because people automatically assume you have to have like 20% down in order to purchase your first rental property or even to buy a house in general.
There's a lot of different ways.
There's so many ways. It blows my mind. So we'll talk about it in a later episode. But yeah, I'm going to link to the website in the description down below. For all you guys listening at home, we're going to see this video later on, possibly Monday when it goes back live or when we drop it again. If you have any questions, any comments, go ahead and leave them down below. If you have any suggestions, you want us to cover a certain topic going forward, definitely hit us up. Next week, we're going to have Chad Murray from Your Credit Coach. We're going to be discussing how to build your credit, how to get over the shortcomings of credit. He's going to explain credit. Yeah,
That's big.
It's gonna be very big, and he does it in a very, because I've seen him speak, and the way he does it and presents it makes it so motivating to face the challenges you have when it comes to credit, building it, whether you have it or bad credit, turning it around. And so I'm really looking forward to having him on next time.
Yeah, so it's gonna be it's gonna be the 13th of November, which is next Wednesday, exactly at 12 p.m. He'll be sitting down with us where we talk about all that good stuff. So make sure you guys stay up to date, or at least you tune in at that time. And then for everything else, Bryan,
Thanks for coming in, man.
No problemo, man. It's always fun to chat about this stuff.
What's the name of that program one more time?
Just go to Bryan Kills Debt and check the link down below. It will blow your mind.
All right, guys. Thank you so much for joining us.
Take care.
All right, see you guys in the next one.
Peace.